Let's talk about the Salesforce earnings. Jenny Horne, host of Next Gen Investing. So it looked like kind of a thin miss. Like it wasn't like a terrible report from them, Jenny, but boy, are they getting punished. So what's going on?
Okay, I think because Salesforce, to me, I've always seen them as a name that gives a more conservative guide. So that to see them miss makes you say that, I mean, like, obviously things are worse than feared. And it's its first revenue miss since 2006, which is, I mean, in itself ridiculous.
Yeah.
So yeah, it was objectively a very narrow miss. The revenue came in around $9.13 billion versus the $9.17 billion expected. You could even find metrics that get you closer to what they were expecting.
Heavy lies the crown.
No kidding. And I mean, it was still up 11% year over year as far as their sales growth, and earnings per share did still beat. So, I mean, there's things that still would tell you that this company is doing well. It was like specifically all 5 of their product areas contributed to their growth this quarter, but revenue from their professional services and their other category were down about 9% this quarter. And they did say that they expect a lot of that deal compression and slowing project growth to somewhat continue in their professional services for the remainder of this year. And I think you have to think about the way in which Salesforce really grew. I mean, it was like the M&A king for so many years in an environment where it was easier to grow. It was less expensive to grow. I mean, like money was cheaper at that point. So now we're seeing a different Salesforce. I mean, the rate in which they're buying companies has slowed. I guess you can make the argument M&A has just slowed in general. But like they had this deal on the table perhaps for Informatica that fell through a few weeks ago. So it's just not like the overall like powerhouse it used to be. And these results come after the company has sizably reduced its workforce, I believe twice over the last several years, and has like this massive real estate right now, like portfolio they're trying to sort of get rid of. We have the Salesforce building in Chicago.
I was just looking at it on the B-roll. It's a nice building.
It's so pretty. It's such a shame.
Wolf Point in Chicago. All right, so look, it's not like if you were to look at this company, if this is your first time ever looking at a business and somebody gave you a Salesforce earnings, you go, oh wow, this is a pretty good company. But the standard has moved so high for them over the years that when they're projecting single-digit growth, I mean, that's like new territory that is the softest and the slowest that we've ever seen. And this is what I was asking yesterday going into this report, is that, that's kind of a seminal moment when you slip into single-digit projections, and that's where we're at. So things have slowed down a lot.
You know, I think it's kind of interesting is like the software trade, I feel like is starting to slow down, whereas like the hardware trade is actually like the Dells, and then like you have names like Salesforce. UiPath, for example, is down 30% this morning. I mean, on its own news, but like Salesforce, I do think we're seeing this like malaise that's hitting a lot of these software names. It's not Salesforce specific, but unfortunately Salesforce is the one demonstrating it with its earnings today.
This is a huge point, I think the most important one, which is the further you move away from the epicenter of basically NVIDIA hardware, the whole AI halo thins out pretty fast. And the narrative was that a lot of these cloud companies were going to be able to deploy new products or tools. There's an argument that some of Salesforce's stuff could be disrupted by AI, that people are able to program on their own.
Just like Adobe. I would make the argument like that AI is not good for your business model. You thrive in an environment where you rely on people using your software.
Yeah, and they talked a lot about it. They have a lot of like jawboning around what AI is going to be able to provide, but nothing in the numbers. So when you don't lift guidance for the future, but you talk about how the future is so good for you, like it doesn't make sense. So that's where I can see the stock getting punished, because it seems like there's a little disconnect here, both in the market's perception of where AI is going to show up in products and services on the software side, versus, and also what these companies are telling us too, to some degree. When they talk up AI and they don't change their guidance, it's like, you kind of deserve to get punished.
Well, right, because like we're trading on the momentum of like a promised a concept that is not actually being like fully executed on. I mean, I know they have their Einstein Copilot, I believe, but yet nothing material, like no material impact to this quarter. And like you said, I mean, guidance was fine. They reaffirmed their guidance, but if you're telling me that the AI is the next best thing and it's like the thing that's going to change the world, and you are a company that operates in software, where's the growth in that matches that? There's the complete disconnect.
Numbers. It's time to see numbers. Show me, right? Everybody's been talking up. It's been a year now.
The show me, not the tell me story.
Yeah, since we unveiled the large language models and stuff, and there's no product to really show for it, outside of chips that are getting bought up in heaps by the hyperscalers. So we're seeing limits of the reach for the tech and the AI trade. Okay, thanks, Jenny.